Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So let's set an implied volatility. So in my example here, I have the biggest assumptions of all pricing models, right? It's a log normal distribution. This is actually would simulate a normal distribution, but I'm big on quick and dirty because I want people to understand the essence behind volatility, not necessarily the exact math. So I'm going to use a normal distribution. It would usually be a log normal distribution only because of stocks, and a lot of people think that it's because, oh, you know, stocks are always bullish, everybody's bullish in the marketplace, but that's not the case. There's an absolute number on the end that it can't go below, and on the upside it's unlimited. So for example, Google could go up to 1,000, but it can only go down to 0. Now there's been many stocks that have tried to go below 0, but most of them have not been able to, and if Enron couldn't do it, nobody could. So in general, the stocks usually can't go below 0, but they have an unlimited, infinite upside potential. So there is a little bit of skewing. Okay, with that said, let's just assume that it's a normal distribution, and then the math is really easy. All right, so we got a stock at 100. That's the mean. That's what it's called. Now, once again, remember, right into historical definition, it says standard deviation. So we got a mean of 100, and we have a price here on the stock at 100, and we have an implied volatility of 20%. Now, the math of the marketplace, if we're just talking about 365 days a year and we're going to trade a 1-year annualized option contract, it's fairly simple. We can actually go out and see what a 1 standard deviation move is. And here in this example, we take the implied volatility, what the marketplace is implying. Now, notice we're using implied, not historical. And to me, that's a very important concept. Now, you can use different things to try to tweak what you think the marketplace will do. But what implied is saying is it's forward-looking. It's stated as or it can be found using the options price. So the options price usually is all-knowing in that if there's some news that's going to be coming out over the life of this option contract, the options marketplace as a whole usually knows about it. So it's a little bit more forward-looking. Like, for example, it gets me scared when a lot of people say, oh, gee, all you got to do is look at the historical, and if the historical is lower than the implied, in that instance, you always sell those option contracts. Well, a great example right now would be in Ford options, right? Right now, Ford is trading at, I looked at the March options just the other day, they're trading at 135% implied volatility on the call side. So do you think that those options are overpriced? Well, they are if you compare them to the historical number. They most definitely are. But there's never been a point in time where Ford has been more in danger of going bankrupt than right now. So is the volatility justified? Is it overvalued, undervalued? I don't know. But the marketplace thinks or is implying that that's what the volatility should be from the option trading that's going on in the marketplace. All right. So now I have this number. What does that mean to me? If I look at my stock, it's trading at 100. I got an implied volatility of 20%. A 1 standard deviation move would equal about 20 points. Now, I always like to use this example because back in the day, this was always IBM. For about the last 5 years, IBM has been a $100 stock that traded at a 20% implied volatility. It's still fairly close. If I look at the quote today, it actually is where it was about 2 years ago. It's around 86. But the implied volatility is higher, but it's higher across the board. It's trading at about 48% implied. All right? So just so that you got a feel for it. And if I know this is going to move 20 points, or if I look at the standard deviation that implies a 20-point movement, what does that say about my market here? It says that if the market's at 100, that most of the time the stock won't move more than 20 points. It's implying that it won't move more than 20 points. Now, on this side, it means 120 here. On the downside, it means 80. And what is defined in statistical terms, in actual mathematical terms, it means that about 68% of the time the stock will stay between those two prices. All right. So in layman's terms, what does that mean? That means they took 1 bazillion stocks, and out of those 1 bazillion stocks that were trading at 100 with an implied volatility of 20%, if they came back a year from now, remember, because we're still looking at annualized numbers, we haven't said that this was a 30-day vol, right? So it's still assumed to be annualized. And they came back and said, well, in 1 year's time, 68% of that 1 bazillion stocks are trading in this range. All right. So that's what implied volatility says to us. It says that it's very hard for the stock to make more than a 20-point move. As a matter of fact, on the upside, it only does it about 16% of the time. And on the downside, it only does it about 16% of the time. Now, these numbers are skewed a little bit. They're a little bit more to the upside just because of the general distribution of stock prices. But in general, that's what this is implying to everybody that's trading options. So now if I know this number, and let's just talk about one of the simplest but maybe most risky trades you can do. Let's talk about selling a call option. If I know that 68% of the time it's going to make this type of move about a 20-point move, what call option might I want to sell? Well, obvious to me it says if I sell this 120 strike right here, all right, 68% of the time the math says that it should be below this 120, and another 16% of the time means it should be below 80. So if I total those two, that means 84% of the time this option, the stock won't make the move above 120. All right, now is where I put the big disclaimer in, right? Now this is standard statistics, and yes, that move can happen more and more so, and it happens in all different places. I mean, there's many times where you look at a football game and a team is favored by 7 points and they end up losing by 20. That happens. It doesn't, and in the options marketplace, a lot of times it says, well, it very rarely makes the 20-point move, but something happens in the marketplace and it makes a 40-point move. So if it was that easy, now realize you're talking about the real world. So I just want to give you my disclaimer. But I want you to get everything that you can on your side when you're thinking about trading options. I want you to get as much information behind your belt. So at this point in time, this looks like we'd have about an 84% chance of success if we sold this call. And normally if I'm doing a live class, this is where somebody raised their hand and says, well, Brian, I want 95% chance of success. All right, well, you just sold an option for a nickel, right? If there's a 95% probability of that happening, you're going to get next to nothing for that option contract. There's going to be a trade for a very low number. So I've always noticed just in my trading, right around a 1 standard deviation move, you can still, quote unquote, get something for it normally. It's usually trading for some decent valuation. And on the opposite side, if I sell this put, what am I thinking the market might do? Well, I want the market to go up. So what strike is interesting, or where do I want to stay focused? Right around 80%. Now, why do I care about this? Now, if I understand this simple little math, and this is what the marketplace is implying when they tell me that there's a 20% vol, means over the life of that option, this is what the marketplace is implying the stock may do. Now, I said may. Now, if I go in and I do this, this means that I can be consistent on any stock that I trade. If I trade Dell options, if I trade, I'm looking at the different currency names, if I trade the British pound, if I trade Canadian dollar, if I trade the euro, if I trade Swiss francs, I can always be fairly consistent in the strikes that I'm picking when I'm doing my trades if I understand this little concept of volatility. Okay? And one last little thing. You know, if you ever want to go out and I actually wrote a little book called The Options Playbook, and I'm going to pull up a slide on this, and I'm going to give one of those away today, actually fairly soon here, so don't sign off just yet. We're going to give away an Options Playbook. We got a little question that we're going to give out, but we also have it online available to the TradeKing clients.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.